talking about the concept of support and resistance. Now, in tonight's class, I've prepared a couple special presentations for you. Now, these presentations that I'll be sharing with you will not be available in the recorded version of this class. But if you want to see these small little presentations another time, if you go to YouTube and look for the channel called Forex and CFD Education, and then look for the playlist for support and resistance, and you'll be able to see all of these little presentations. Also, if you notice on your screen, I've prepared 2 handouts for you. These handouts are only available during the live class. So please click the little download button and download them to whatever device you're using, and then you can move them around at your convenience. One of them is the Introduction to Technical Analysis ebook from investing.com. This is a very extensive piece of research information. This is not a simple 3-page marketing ebook. This is like a 40-page introduction and explanation of technical analysis. Also, I put together a handout for you called Support and Resistance Indicators. And this is a small covering of tonight's class with charts and diagrams that will explain everything to you. But you're only available in this live class. Now, tonight in class, I'm going to use the term security, but I might use the term asset. I might use the term stocks or commodities, or I might say cryptocurrency or Bitcoin. I might say the euro. But I'm basically referring to all and every asset that is traded in the financial markets, in the open markets. Okay, it just gets very, very boring saying security, security, security over and over again. Also, I intermix the terms investing and trading. Now, typically an investor takes a long-term position while a trader takes a much shorter-term position. Most of us here tonight are traders, but it also gets very boring just saying trading, trading, trading. So I mix up the term investing and trading. But it doesn't matter, these concepts fit either one. Because support and resistance fall under the area or the grand scale and scheme of things under technical analysis. Now, we're all trying to get the answer to one big question. Should I buy or should I sell today? And even more so, we're all asking, what will the price be an hour from now, 2 hours from now, by the end of the day, by tomorrow, next week, or next year? Well, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But I don't have a Ouija board and I don't have a crystal ball. And if anybody tells you they can predict exactly where a price will be an hour from now, 3 hours from now, tomorrow afternoon, they're full of it. Because there is nothing that will assure you where price will be. But if you're attending this class in the hopes that technical analysis and using support and resistance has the answer to these questions, I'm afraid I have to disappoint you. It doesn't. Because like I said, nothing does. However, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, it sure will. Now, these concepts, I try to explain as the floors above and below price. So if you imagine that price is like an elevator moving up and down in a specific building, it can be a low-rise building, it can be a high-rise building, it could be a super or skyscraper building, but it's still the elevator that's moving up and down. And when you're standing in this elevator, there's something supporting your feet. That's the floor under your feet. If you want to move up, what do? You have to break through that ceiling above your head. And that ceiling above your head becomes what? The floor under your feet. So it becomes your new support level, because the ceiling when you're trying to move up is your resistance, because you have to break through it. That's hard to break through it. But your floor is supporting you. And each time you move up from one level, it becomes the floor under your feet, and becomes the next comes the resistance. Not a difficult concept. Okay. And if you always imagine as an elevator, what happens when you want to reverse and go down? You need to break through the floor. So the floor is now your resistance. And each time you break through that floor, the ceiling is supporting you. It's holding, it's what's pushing you down through the floor. So the concepts just simply flip up or down depending on whether you're in an uptrend or a downtrend. Now, support and resistance is one of the most widely used concepts in Forex and CFD trading. Strangely enough, everyone seems to have their own idea on how you should measure support and resistance. There are many ways to get these levels, but the concept of support and resistance forms the basis for technical analysis. Traders look to buy at or near areas of significant levels of potential support in an uptrend, or look to sell at significant levels of resistance in a downtrend. So if we go back to my elevator scenario here, if we know something about price and price movement and the frame in which it's moving, we can start determining those levels or floors that price will move on. So let's take, for example, this simple little low-rise office building. We see it's on a very busy corner in a metro area. And I'm telling you, we've already decided it's on a major mass transit level. It's just a block from a major train station. It's got the ground floor level. It's got a first level, second level, third level, and a rooftop level. Well, we notice on the rooftop level, what do we have? We have lots of people outside, because guess what? That's the smoking area. Okay, so it's the lounge and the smoking area for the employees and the people in this building. The first floor, or the ground level, we can see is retail. So what we're doing is we're observing. We're observing price and the area or the range around what price is located in. So same thing, we're observing this building. Okay. So imagine this building, instead of being an architectural building with blueprints, it was a price chart. Now, while we're observing this building, we can say, oh, look, the street lights are still on, so we know it's early morning. We look inside the building, and we can see there's a coffee shop in there, there's a donut place, there's a little bakery, there's a little grab all your stuff thing, a little sandwich shop, and a couple retail stores. Like I said, we see we're on a mass transit line. We know we're right by a train station. So we know early in the morning, as people are coming to work, it's going to get fairly busy in here with people picking up their coffee while they're running to their offices, or picking up their donut or their pastry or their, whatever they're getting in the morning. And they're running through this building and off to work. Lots of traffic on the ground level. But in the morning, is there lots of traffic to the upper levels? So what we're going to do is, since we're observers and we want to observe how price moves throughout the day on a financial chart, because basically trading is looking at the historical price movement of an asset to try to predict where price will move in the future. And support and resistance comes from knowing where price and how prices reacted at certain levels. Now, by observing this building, we now notice that in this first floor here, it's high-end offices, doctors, lawyers, dark wood floors, dark carpet, but not places that will get a huge amount of street activity. So what happens is we get in the elevator. Now, we're priced. We can't control the elevator, so we're just standing there observing. So as the elevator goes past the first floor, we observe what's there. Okay. We can figure now that, okay, it rides up to the next floor. And what we see on the next floor is we can see that this is the office is extended from the ground, the first floor. And this is where lots of the staff work. You know, the law offices and the doctor's office have their second, internal second floors. So we know there's not going to be a lot of traffic to the second floor here. Mostly employees. Third floor, we notice is conference rooms. Okay. Because when the elevator door opens, we see signs for conference room A, conference room B, conference room C, conference room D. And we can see little signs on there saying, some kind of conference at 11 a.m., some type of meeting at 2 p.m. Well, what is that like? That's like the economics calendar. We know times a day that certain things will happen. And then, of course, we go up on the elevator to the top level, and we see soda machines, coffee machines, tables, lounges, and we see all the outside area for the smokers. Now, by using our intelligence, we can figure out if it's 7 o'clock in the morning, there's probably not going to be much traffic to this floor, or this floor, or this floor. There's going to be lots of busy at this level, and probably when we see the elevator going up, it's probably going to be going up to the smokers level. Because the people coming into work, that did come into work, that went to the offices, they're going up to have their morning cigarette and morning coffee. Or some of the people coming in, grabbing their coffee here, are going to go straight up to the roof to have their cigarette before they go into their offices. As we get closer to 8:30, 9 o'clock, we'd expect this floor and this floor to start getting activity. So by knowing this, by observing this, we can start predicting how this elevator will move. Because we know in the morning, before 7:30, 8 o'clock, that elevator is not going to move much, but when it does, it's most likely going to move to the roof or maybe the first floor. But there's no conferences, no conference rooms. But what we're doing is we're observing price history, price action, price, how it is worked on historically on price. And we're getting the levels that are important. So if you something, this resistance and support are not just random levels. They are levels or floors and ceilings that have been established over time, where prices either had a hard time moving through or prices reversed. So we have, and if we understand this, we have groups of traders. Say for instance, in an uptrend, prices moved up. Now what happened is, for some reason, prices started to rally. We never know what price starts a price runoff. Could be an economic event, could be a central bank action, could just be a goodwill, buyers coming to the market looking for something to buy. But price starts moving up. It's going to move up and up steadily as buyers enter the market, and price will move up. But we know price doesn't go in a straight direction. Price doesn't go like that. It moves up in peaks and valleys. And these peaks and valleys are established by support and resistance levels. So what happens is, as price moved up, it hit this resistance level, which had been established historically. And what happens is the buyers who are buying in the market say, you know what, we think price is getting too high. So we're not saying it's not going to continue up. We're just not buying at the moment. We're going to move over to the sidelines. Other buyers who bought here are saying, okay, I've made my profit. I'm getting out of the market. Because they said, okay, if it's got a 20 pip move, they already put their limit orders in. They know, based on their sales plan or their trading plan, that when it gets up 20 pips, they're closing out their position. That's all they were looking to make. So as it gets nearer and nearer this previous established resistance level, price will start to ease down. Not saying it can't go through the resistance level like it did in this case. It moved up to the next resistance level and then bounced off. As it bounces off and gets lower, those buyers who were sidelined start entering the market saying, this price is getting more attractive again. Okay. And as they enter the market, the price starts moving back up again. And it's establishing new support and resistance levels. And these levels will be brought forward because this level at this point isn't doing any good here. But these levels are then projected forward. So when price is in a downtrend and recovering or downtrending, it's going to have these significant price levels that have been established that we can expect an action. Not that we expect the market to do anything in particular, but a stronger a support or resistance level is, the more action we can expect at that level. It might be just a dip, it might be a hem and a haw, it could push right through it, or it could bounce off. But we know that we're going to expect some type of action at that level. So one thing to remember is that support and resistance levels are not exact numbers. Oftentimes, you will see support and resistance levels that appear broken, but soon after find out that the market was just testing it. With candlestick charts, these tests of support and resistance are usually represented by candlestick shadows. So in other words, as price falls down to a support level, we wouldn't expect the body to go through. We'd expect the wick of the candle to go through, but the body to honor that level. So these are tests. So the traders are trying to test out whether they're going to keep pushing the price down or the price is going to go up. Now, support and resistance, it's just common jargon for areas on a price chart where prices had a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels like a price ceiling that price cannot break above. Knowing where these levels are make it much easier to decide when to open and close trades. But how do you locate these levels? Because there are many different ways to get support and resistance and how to establish these levels. So we can use swing highs and swing lows. We can use something called a pivot point chart. We can use Fibonacci retracement levels. We can use what I call eyeballing or historic levels. So I'm going to share a presentation with you that can explain this a little bit better. And it's going to show you how we're going to start out with eyeballing. Okay, and then from there, we're going to go over and look at other ways. But to me, eyeballing or finding historical highs and lows by using high points and low points is the best way that any trader can, because you're now working on a chart and interacting directly with these levels. So let me share this presentation with you. It's a little bit long because I had to detail it out for you and show you this. But once you've learned it, and it is the best way, once you've mastered it, you know it's not long at all. And once you've actually, if you're not a crazy person and you're trading only a certain range of assets, once you've got these levels put on your charts, you never have to worry about them again because they will go forward with you.
So let's start with what support and resistance is. I think when a lot of traders think of support and resistance, they think of pinpoint lines on a chart that try to predict where the price will turn on a dime. But it's more complex than that. Let's start with the basics. Support and resistance refers to the technical analysis of price areas where the price action will potentially pause and change direction in any given market. If there is a price area below the current price action that has the potential to stop the price falling further and change its direction, we call this support. If there is a price area above the current price action that has the potential to stop the price rising further and change its direction, we call this resistance. Price can and does break through these price areas all the time. Typically, when price breaks through a particular price area that has been identified as either support or resistance, it will become the opposite to what it was before. So if price is rising and it breaks through an area of resistance, that resistance area now becomes a support area for the price. And the same is true in reverse. If a price is falling and it breaks through an area of support, that support now becomes a resistance area for price. There are different types of support and resistance levels, and I like to split them up into two categories: static support and resistance and dynamic support and resistance. Static, as the name suggests, are support and resistance areas that don't move. They are identified by the specific price level that the historical price action has shown them to be at. This is the main type of support and resistance people know and refer to when they talk about it. Dynamic support and resistance is the opposite. It refers to support and resistance levels that move. They are not at a fixed price. I use two types of dynamic support and resistance areas as part of my trading strategy, which are daily pivots and moving averages, and these levels change regularly. Daily pivot levels are specific levels of support and resistance that change on a daily basis. So I will have a set of daily pivot levels plotted on my chart on the Monday, and then these levels will change on the Tuesday. Monday's pivot levels are now no longer of interest to me on Tuesday, as all the levels have changed. Moving average levels are dynamic as well, as they are constantly changing with the formation of every candlestick. Dynamic support and resistance levels, such as daily pivots and moving averages, usually plot themselves through indicators within a charting platform. So if you add the daily pivots and the moving averages to your chart, the levels will update as soon as they need to. Static support and resistance areas usually have to be identified and plotted manually. So let's look at how we do this. We can identify these price areas by looking at the historical price action on our charts. We are looking for price areas where the price has been heading in a particular direction and then has stopped and reversed in the other direction. Equally, we can spot an area of support or resistance if the price has been heading in a particular direction and has paused for a significant amount of time before breaking through the area and continuing in its original direction. Sadly, support and resistance areas aren't as clean in reality as demonstrated by these illustrations. So let's jump over to the charts and look for some real life examples. Okay, so here we have the daily chart of the FTSE 100, and as you can see, currently the price is up at the 7,300 level and has spent the last couple of months around the 7,000 level. Now, to demonstrate how to identify and plot support and resistance areas, I'm going to scroll back on the chart to the last time the price was in the same region as it is now. This way we can use the support and resistance areas we plot from the previous price action to see if they have any significant impact on this price action that's happened over the last few months. So I'm going to draw two red lines, one above this price action and one below, very quickly. There we are. Now we want to scroll back and find the last time that the price was between these two lines so we can use it to identify and plot the support and resistance areas for this price region. So if we scroll back, we find that the last time price was in this particular region was sort of December, January to August 2016. So in order to start plotting the support and resistance areas, we first need to identify where they are. And as I said in the video previously, we need to spot the points where price has had a significant reaction. And to do this, we want to find where price has either been heading in a particular direction, has stopped and reversed, like here, or where it has stalled for a significant amount of time before either breaking through a particular area or reversing. So this area here, for example. And to plot these areas, I'm going to take my circle tool and I'm just going to first pick out all the reactions that I can see on this particular region of price action. So as I said before, I'm just picking out all the reactions where price has either reversed or stalled, and I'm just highlighting them so I can see them more easily. Fantastic. Okay, and now to plot the areas, I'm going to take my line tool and I'm going to work my way down the chart until I come to a reaction point. So the first reaction point I come to is this one here. And I want to encapsulate this reaction with the two lines. So I want to take the highest point the reaction occurs and I want to try and place my line at the lowest point where the reaction occurs. And then once I've done that, I can delete my circle. So here we have our first support and resistance area. And then all we're going to do is work our way down the chart, picking out these reaction points, their lowest and highest levels. Another one here. Another one here. This one has more than just the one reaction from it, which is fantastic as it gives this particular area a little bit more weight in future use. As we come down a bit further, we've got this one here. To there. Actually, this one could probably come a little bit lower and encapsulate that reaction as well. And then we've got one down here to there, got another one here to there, and then we've got another one here to there, and then we've actually got another one here to there. And then we can delete our circles, as all of these reactions should now have been encapsulated in the areas that we've drawn. So that one has, yep, yes, 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 and yes. Now you may have spotted that there is a particular area here that doesn't have any support or resistance area within it. And it does look quite a large area to not have any sort of area in there at all. And all that will have happened is the particular price action that we're looking at here will not demonstrate where this particular area is. So if we scroll back further, here we are, we can see that the price does react within this particular area, but just not in the price action that we were looking at. So we can use this price action here to identify this support and resistance area. It's fantastic. We now have all our areas plotted. And to make these a little bit more visible for us, I'm going to colour them in with this rectangle tool. So I will speed this part up as it's quite boring to watch. Okay, all done, and as you can see from the daily time frame, the price action has reacted in the support and resistance areas we have picked out from 6 months previous, but if we drop down to a lower time frame, we'll be able to see these reactions a bit more clearly. So let's drop down to an hourly time frame, and let's work our way backwards from the most current price action. And as you can see, price has respected the support and resistance areas we picked out from 6 months ago rather consistently. We are seeing price move into these areas and then either reverse or stall all the time. We can see as price breaks through a particular support and resistance area, like here for example, it does then revisit it and use it as support. So initially this area was resistance as price moved up into it. It broke through, revisited, used the area of support and moved up. This analysis also reinforces that support and resistance is best identified in price areas rather than pinpoint levels. You can see sometimes price will revisit a particular area, looking at this one here, on multiple occasions, and each time it will get a reaction from the area. So we've moved down, bounced up, moved down, bounced up, moved down, bounced up. But
now, the important part of putting these support and resistance levels on your charts. And as you see, I had to do that in a separate presentation because it has to be all done, put together for you. Otherwise, it would take forever, and it's just easier that way. Now, the whole basis, since most of us here are CFD traders, we're trading in small time frames, is once you've plotted your support and resistance levels on longer time frames, you keep coming down to smaller time frames and plotting the support and resistance levels in between. Okay, because like I said, these levels are valid, and they're going to be valid 6 months from now, a year from now, 2 years from now. So once you have them on your charts, you never have to draw them again. When price moves out of these zones and moves up or down, you keep building your levels above and below where price currently is. When price moves down to that range again, all those zones all move forward and become valid again. Now, the 1 day or the longer term support and resistance levels are more important because they will be respected more by price, because not everybody's trading CFDs and short-term traders. So the longer term levels you should mark in, say, red. Then when you fill them in, say, with a 4-hour chart in between, finding those ranges, fill those in with blue. And then when you come down to your 30-minute chart, fill those in with red, because you're going to use those support and resistance levels for your entry and exit points for the shorter term. For the longer term, you're going to use those for your marking points, where you would find, where you would decide to put your stop loss, where you decide to put your take profit levels. So you use those for many different ways. Now, a lot of this is explained in the handout I gave you. I also mentioned in the video the static and the non-static. Pivot points are very easy, but pivot points are not a part of observation. Pivot points are calculations. They calculate based on the high, the low, the high, the low, the open and close. Now, they come from a pivot point calculator, but these give you support and resistance levels. Now, for CFD and Forex trading, they're being recalculated all the time. And you can find them like on investing.com. If you just go under the technical analysis for whatever asset you're looking for, what you'll see is the current pivot point charts, the current pivot point support and resistance levels above and below, 3 levels above and below the current price. And as price moves, they're constantly being recalculated. Okay. Or you can use a simple pivot point calculator, but then you're inputting all those, the opens, the high, the lows, and the closes. Okay. And you can draw these on your charts, but these are non-static because they're moving regularly. But combining them together will help reinforce, because you'd be surprised how many times that these pivot point levels actually fall right over top of your eyeball or historic support and resistance levels. Because markets ebb and flow, they go up, they come down, they move sideways. The primary way we make sense of these movements are analyzing price action as well as levels in the market where price bounced higher or rotated lower. Now, the fact is, if you want to be a trader, you should only be trading markets that are trending. Okay? Not trending sideways, trending up or trending down, and then have well-defined trades, because you can always find assets. There's a zillion assets to trade. If an asset isn't trending, you shouldn't even be wasting your time on it. If it is trending, these support and resistance levels tend to hold much better. So support and resistance levels form the foundation of technical analysis, and they help us build a framework from which we can understand the market. For price action traders like us, support and resistance levels help us plan our stop loss placement and our profit targets. But perhaps more importantly, these levels give us a way to make sense of the market in terms of what it has done, what it is doing, and what it might do next. Now, that is a very, very important level. It's telling you what the asset has done in the past, what it is doing at the present, and what it might do in the future. It is helping you decipher the movement of the markets. And this is what all of us want, is help understanding how the markets are moving. Now, I've got a little presentation prepared for you on a simple strategy that you can use to incorporate. But also, I'm going to give you a way that we can locate. We're going to use locating a trend with support and resistance and how to incorporate it into our trading.
So apart from helping us to identify potential trade areas, one of the other common uses for support and resistance is helping us identify whether a market is ranging or trending. If price is making higher highs and higher lows by breaking resistance levels and using them as support, then the market is said to be trending upwards. And if the market is making lower lows and lower highs by breaking support levels and using them as resistance, then it is said to be trending downwards. If the market is moving sideways between two levels of support and resistance, then the market is said to be ranging, as it is not making any significant movement to the upside or the downside. Some traders have strategies they will only employ if the market is trending or ranging, so using this analysis helps them to decide whether to implement a particular trading strategy or not. So why does support and resistance work? Put simply, support and resistance areas work because lots and lots of traders are watching them. Traders identify these areas because you tend to get a lot of trading activity at these levels. Some traders will be waiting to trade the reversal at the identified area, and other traders also like to trade the breakouts, whereby price breaks through the support or resistance area and the trader takes the trade in the direction of the break. So if price broke through a support zone, the breakout trader would sell the market in anticipation of the price falling further as it has broken through a support area. All of this increased trading activity usually results in either a victory for the buyers or the sellers, and because more traders are active at these levels, the reversal or breakout usually happens with some purpose and intent, which is what makes trading these opportunities so attractive to traders. However, it is worth mentioning, as with all forms of technical analysis, support and resistance is an art, not a science. There are going to be occasions where the market seems to forget that a support or resistance level is even there. It may just blast straight through it without even giving us an indication that any kind of reaction took place there at all. Or it may break a particular support or resistance area, and then reverse, having already broken the area. We call this a fake break, and it can trigger breakout traders into a losing trade. It can also frustrate reversal traders, as the signal for the reversal doesn't happen in the identified support and resistance area. What we as support and resistance traders have to do is have other mechanisms within our trading strategy to refine which opportunities we take at support and resistance levels, other than just identifying them and waiting for price to reach them. If trading was that easy, we would all be millionaires. So how should you use it? For me, support and resistance is a key part of my trading strategy, but I do not use it in isolation. I have other analytical techniques that I use and wait for to give me confluence before trading. If I were to trade solely using support and resistance, I wouldn't be profitable, and it's as simple as that. I personally think support and resistance works best when you use it as one of a few layers of technical analysis that make up your trading strategy. For example, you could use it as the foundation of a strategy and build on it with a few different types of dynamic support and resistance, like moving averages and Fibonacci levels. Or you can use it to build on a strategy where the foundation comes from something like Elliott wave theory and look for a particular candle pattern when both streams of analysis line up. Like with any successful trading strategy, you need to have more than one analytical method.
Now, if you notice in that little presentation, I mentioned Fibonacci levels. Now, Fib levels are a tool to measure movements of or levels at which a asset, when it's reversed and moving. Okay, the idea between a Fibonacci retracement is that when an asset has, say, rallied up and it's moved up 100 points, that it will tend to retrace 38%, 50%, or 68% of its prior move. Those levels that are then drawn on your charts using Fibonacci retracement tool become also support and resistance levels. Now, I don't use fibs that much, but I do use the 50% retracement level. Excuse me. Now, the 50% retracement level isn't actually a fib level. It comes from Dow theory. It was developed by Charles Dow. And it is his belief, and he's the father of basically technical analysis, is that a asset will retrace 50% of its prior move. So in other words, as we can see in this example, this was the beginning of an uptrend. This uptrend ended here. So when price is falling or retracing, it will have a good chance of retracing 50% of its move before bouncing back up and continuing on its way. Okay. Now, whether you're going to use it or not is unimportant. That 50% low level also can become a level of support and resistance. Because you notice here, it supported the price above here. So that is another support line or resistance line we can add to our charts. Because the more of these levels that we have, and especially the more they are confluent, that they actually overlap each other, the more valid they are and the more we're going to see reactions at those levels. So I've got a chart prepared for you. Let's see if I can jump over to my charts. Okay. And see, as we can see here on this chart, I've already drawn on here our support levels and our resistance levels. And this is our first level of resistance, our second level of resistance. This is our first major line of support. And you see it's got the pink areas because those become zones. And I use them more as zones because we've actually combined this also with a 61.8 Fibonacci levels, retracement levels. Okay. So, and as we can see, as price is moving down and up, it's coming up to this level, bouncing off, coming back down. We would project it to come down this far, but it didn't, but it eventually did come down to that support level, bounce back up, move back up to the resistance level. And now at this point, we're expecting it to come back down to that support level. And because lots of traders are watching these levels and these prices at those levels, okay, doesn't mean that they're going to stop there. It means that they're going to take a breather there. They're going to give me some type of reaction at those levels. Sorry, let me just get some of these marks off of here. So again, you can see this done. So we were looking at the gold chart. Now we're looking at the euro US dollar, and these are current charts right now in the marketplace. And we've identified the support and resistance levels. We see that the euro has moved up 3 times over the last few days up to this resistance level, bounced off of it, came back down to that 50% level. Now it came all the way down here, ignored it entirely, but then moved back up into that resistance level. Now it honored that 50% support level here, moved back up, bounced off of the resistance level, and is moving back down to that support level. So we've identified these, and you can see how valid they are. So they really do work. Now, I want to share one little last presentation with you, which is actually a strategy. Now, I've explained this to you in the handout. It's just a little quick, simple strategy using support and resistance, and I've just put together several slides to show you step by step. So watch for the explanations at the bottom of the slides as it goes through on your screen. It's just very short. And again, you can see this by going to the CFD Forex education information I gave you on YouTube, and under support and resistance, you'll see this presentation there also. I'll try to run that through for you one more time here. So we've gone over major types of support and resistance and how I use them as indications of market conditions. Levels to look to buy or sell from, levels to define risk, and as a framework to understand what the market has done, what it is doing, and what it might do next. When you combine a solid understanding of support and resistance levels with price action and market trends, you have a triumphant of trading. You have a great place to make trading decisions. I use basically chart formations, trend lines, and support and resistance levels. That's what I use for all of my trading. I pay very little attention to the whole area of technical indicators and very little else, because all you're trying to do is find entry point and exit points and try to find high probability trades. It's more about risk and money management than it is anything else. So to get a better understanding of all of this, if you go to www.alvexo.com and sign up for their education academy, you can watch videos, you can read books, they will provide you everything. They'll even find you some time with a one-on-one analyst to help you better understand this. But support and resistance doesn't have to be confusing. We can mix and match any methods and create a healthy amount of price levels that we can trade. As always, practice makes perfect. So make sure you test out these methods yourself on a real-time demo account. And you'll be surprised. This will define, first of all, eyeballing makes you interact with the price chart, and you will become like from Star Trek, you'll become one with price. You will get a much better command and understanding of how price is moving. And anytime you can get where it has been, where it is, and where it's going, hey, you're right in the money. So on that note, I'm going to say thank you very much for joining us. Again, give Alvexo a shot, and we'll talk to you again real soon. Good night now.